Hello, everyone. Welcome again to our quarterly podcast, or whatever we're calling this, where we talk. Jack Bowers and I. Jack is there, I, our chief investment strategist. I'm Ken Weber. I used to say president, but now I'm CEO of Weber Asset Management. Today is the 17th, is 7/15. That's July 15th, 2026. Jack, as always, we have a whole bunch of stuff to cover, to talk about. We're going to talk stocks, bonds, the market. But what people are writing to us about and asking us about is AI and its effect on the economy and the market. So
Mhm.
let's start the ball rolling with that.
I kind of view it as the kind of third industrial revolution. We're in a process where we suddenly have automation on a scale that has not previously been possible, and making it all possible are these frontier models that are being developed that are getting smarter with each new release, and of course the huge data center construction boom that is creating the kind of inferencing and training capacity that's necessary for developing these models and putting them out there. So it's got a lot of unknowns, but at the same time promises a productivity boom that's perhaps unprecedented. And I view it as being bullish for stock market earnings.
Long term.
Yeah, long term. I
Yeah.
think there's a lot of investment that has to take place short term, but we will progressively see benefits that more and more affect the economy as time goes on.
And my question is, and I'm not the first to bring this up, it'll affect certain sectors much more than other sectors. I
Yes.
mean, people are talking about certain sectors are going to lose employees. They're going to let employees go because AI is going to replace so many kinds of jobs. And the question is, just like with other revolutions, is it a worry because they won't have work, or will there be new jobs created,
Yeah.
new spheres of employment? Um,
I think
because
what we've seen so far is most of the layoffs are occurring among the companies that need to put a larger amount of capital to work creating the infrastructure for this. And those same companies also have small armies of programmers on their payroll. And that is one of the things that the frontier models do best is coding. So necessarily, if you need to make a large investment in AI and you have a lot of coders on your payroll, it makes sense to perhaps shrink down, let AI do more of the work, and that allows you to have more capital to invest in the data centers that are going to be powering this revolution. So we're seeing kind of the magnificent seven companies that are big on data centers doing this. Probably will continue to do it. We're also seeing
that's like Nvidia and Microsoft and
right.
Apple, those companies. Yeah.
Yeah, not so much Apple, but I think there's a big four: Meta, Google, Nvidia, and
And many of the funds that we're holding for our clients have that
yes,
magnificent seven, have the
that's
Big
true.
Ten or whatever you want to call it.
But yeah, the what you need to create a data center is getting more and more difficult and costly and supply constrained as time goes on because everybody's trying to anticipate what is going to be required, but it's putting demands on the supply chain, most notably with the memory makers, which for years and years and years struggled to make money and now suddenly have a price for memory that's almost 10 times greater than
Yeah.
recent history. And so now they can't get enough capacity. Most of them are building larger chip factories to create more memory. At the same time, we have a bunch of dedicated AI chips being constructed for real world AI. So yeah, it's one constraint after another, but one way or another, this all happens. There's
Yeah.
too much at stake productivity wise to
Yeah. Clearly, AI is unstoppable. It is going to change lives. The new chips are coming. We're going to have more and more AI in our hands.
mm-hmm.
We have some already. There's going to be more and more of that. Um, Lots of potential, lots of dangers. Jack and I could probably talk an hour about AI. I'm not going to let Jack do
Yeah,
that
I can kind of summarize
because
the trim and
yeah,
trend in 30 seconds, and that is that as these frontier models get smarter and people find them
When
more,
you say frontier models, you're talking about the AI themselves or the companies, the corporations that are doing it.
the companies that are creating these super smart models that can do these things like code.
And Anthropic and those.
Yeah, Anthropic is kind of the leader. XAI, owned by SpaceX, is fast catching up with Grok, and Google is in there as well with some really smart models. And as these models become capable of doing useful things, automating human tasks more effectively, the demand for inferencing and data centers and memory goes up.
Yeah.
And it's conceivable that it goes up by a lot.
Okay, so before we lose any viewers here or listeners, we have to relate what you're saying now to the investments that you and I have our clients in, the various funds and ETFs. And I must say, fingers crossed, no guarantee for the future. Don't want to jinx anything, but our portfolios have done very well this year. Again, no
I
guarantee for the
think,
future, but Jack was explaining to me why that is.
yeah, yeah, I can take the select model because it breaks things out pretty clearly. You can see where the gains have been occurring, and we have a market weighting in the technology sector, which is 35% these days. It's actually now grown to be, I think, 38% of the S&P. So, this is where all the growth has been, earnings wise and stock value wise. And Fidelity has, within the Select Technology Fund, made some very smart bets on the chip makers, and those have been very profitable so far this year,
Well,
allowing
not yeah.
allowing the
Uh,
fund to
go
outperform
ahead.
its benchmark. And so, yeah,
Yeah,
a
the
large
select system, is doing really well. Not all of our clients have the select funds, but you also have for some of the other portfolios like New Millennium,
yeah.
um,
Yeah, New
which
Millennium has done well because of the SpaceX allocation, which is now up to 7%. Um, you know,
7% of that portfolio.
portfolio. Most of the gains, of course, came before SpaceX went public, as
Now,
right
now let me clear
around its IPO price. So,
let me clear that up for astute listeners or watchers, because like today's headline is that SpaceX is now below its IPO price. And when people say we're in a fund that has a 7% position in SpaceX, oh, what did we ever do to us? Um, explain about why we don't really care about the little bit above or below 135 as the price.
yeah, it's kind of a long-term bet. In New Millennium, Contrafund, OTC, and a few others,
Well, what I meant, I'm sorry. What I meant was that New Millennium, for example, apparently got the price, as you told me, 1/10 of the current price.
yeah, yeah, those funds all invested back in, I think it was 2017 when they made a $1 billion investment along with Google. And they allocated those pre-IPO positions to a handful of funds, and those funds have simply held them ever since, and they're still holding them. Possibly because of a lockup arrangement or agreement, or just possibly because they think it's a good investment. So, but originally these positions were well below 1% of their assets, and now they're 7%. So it's all come from appreciation in the valuation of SpaceX.
Right, right, right. All right. So let's talk about what we do all the time. We'll start with interest rates. Always impossible to really get a precise handle on. But your thoughts right now?
Well, it's pretty clear that the Fed is done with the easing cycle at this point in time because of the oil situation. We're now kind of in a situation with the Strait of Hormuz that it may never go back to normal, and alternate infrastructure, pipelines, et cetera, will have to be created for oil, and the U.S. and Canada will have to continue stepping up LNG, liquefied natural gas output, and probably by the end of next year, somewhere in there, where everything may be back in balance, even without any tanker ships resuming travel in the strait. But meantime,
Nothing. Yeah, the short term is. very, very iffy as Trump changes the plans almost daily. The strait is open, the strait is not open. A
Mhm.
week from now, who knows where we'll be with that. So,
Yeah, yeah. It is interesting that the energy prices right now are not as elevated as they were when the war first began. Uh,
right.
some of that is due to the Russian situation, where Ukraine has taken offline a number of Russian refineries. So Russia is simply selling the oil they would have used for their own economy to China and India, and that's taken some pressure off the oil prices globally. But I do, and some of it is just conservation. With the price spike we had before, people found ways to do things, with electric transportation or some other way, and now global demand is easing to some degree. So things are staying in balance reasonably well without really high oil prices, but at the same time, we have a higher than 2% underlying inflation rate in the economy now, and that's why the Fed
Right.
situation.
And 2% being the target that the Fed likes to have, target inflation rate of 2%. Uh, there was sort of good news when it was what 3.2% in the
Mhm.
report yesterday, which was good news. That meant it came down a little bit, but it's still well above the 2% target.
Yeah, and while Powell was okay with letting inflation kind of take a long time to go back to 2%, Warsh has made comments that suggest he might be a little bit more of a hawk in maintaining
Oh,
2%. So,
Donnie is not going to like that.
yeah, yeah,
Oh man,
uh,
because Trump put him into that position,
right.
expecting
Right.
lower interest rates.
And he's kind of a disruptor of sorts, but it's more in shaking up the way the Fed does things. Wash wants to make the Fed less transparent, let the markets figure it out more, and also be more quick to arrest inflation on the upside, but more quick to ease, on the downside. And I think that's a good plan in an age of AI, because there are a lot of unknowns, and we could be, right now we're battling oil-based inflation. 2 years from now we could be battling productivity boom and deflation caused by AI. So having a
That's
guy
right.
there that is more responsive and willing to act quicker than the Fed has in the past, I think, is the right thing for the current economic situation.
Right. Okay. So translate that now to the stock market.
What the main thing that's defining the stock market right now is kind of the earnings boom, which is mostly tech driven, but it's also showing signs of broadening across the board into other industry groups and in even to smaller companies, mid caps.
Right. So let me interrupt because people are pointing out that the market is booming. The S&P as of today is up almost 11% for the year. And people are pointing out it's really top heavy. That 10, almost 11% is the top 10 or 15 or 20 stocks, the largest ones
Yes.
on the S&P. And many companies are struggling
Yeah.
on the S&P.
Concentration has
So,
gone up without a doubt. The tech sector being, 38% of the S&P 500. And I can see a scenario where that goes above 50% in the next few years.
really,
So,
yeah, yeah.
because there's no sign that while the earnings are broadening into other groups, and the benefit of all these AI models and automation will, in theory, benefit all industry groups over time. The tech is still kind of the leaders, and will be the ones that see the early benefit.
Right, right. Yeah, so for our clients, we are the aggressive accounts are still fairly aggressive with a
Mhm.
good exposure to technology. If and when that bubble, and I use that word advisedly, it may or may not be a bubble. If and when that bursts, they'll get hit. So we'll ride through that because I consider it expected. Jack, I think you're more optimistic
Yeah,
short term than I am.
this is
Have been for the last
different
several
than the internet
quarters.
boom from the early or the late 1990s that we saw. During the time that stock values were going up, then nobody was worried that they were creating too much fiber capacity, for example. Today, though, everybody is worried that we're creating too much data center capacity. So I think there's a healthy skepticism of of the AI
Hmm.
revolution, and at the same time, the AI revolution may not have a bust cycle.
I would say I'll disagree with you slightly. I think people are using the B word, the bubble word, not so much about too much capacity on the AI centers. That's not the focus. I think the focus is the big companies aren't really earning anything. They're still losing money in the AI world. So
Well,
I,
they're very profitable for other reasons. So they've got the cash flow to invest in the AI infrastructure they're creating. So while some are starting to borrow to do this, most have been funding it out of cash flow. So
okay.
the big problem with the tech bust in the after the 1990s was that it was largely debt driven, and no profits ever occurred in time to service the debt, and so there was a very
That's true. That's a big difference.
yeah, and it's hard to see that scenario this time around because everything has been done out of cash flow, and the valuations gains that we've seen, for example, with the chip makers, have all been earnings driven. It's not a big expectations rally; it's an actual earnings rally. So I think for that reason, and because the AI models are probably getting smarter and seeing more demand as time goes on, I think this is a more durable rally than what we saw back in the 1990s.
No guarantees, folks, but
No, you never know.
Jack,
But my focus is not on kind of buckling down and cutting back tech and waiting for the crash by any means. What I'm trying to do is just keep a market weighting in tech, and at the same time make the value side of the portfolios as effective as it can be, so that if we do end up with a continuation of short-term sell-offs, the value side of the portfolio holds up. As an example, on the sector side, we might put an energy position into that portfolio for the simple reason that it's the cheapest sector out there, and if we do get higher interest rates from the Fed, the energy stocks are unlikely to be affected by that.
right. So to clarify again for our listeners, Jack is in charge of helping select the investments, and my goal is to, within what Jack says, make sure that every client is in the appropriate risk level. So that's the relationship here with between Jack and Ken and the people I work with here. Um, yeah, you've explained it beautifully, Jack. We just have a couple minutes left. I want to ask about bonds. I mean, you
Ah,
kind of
yeah,
foreshadowed it when you talk about the Fed and stuff, but let's talk about the bond funds.
yeah. The bond market has been pretty stable and hasn't overreacted too much to the situation in the Strait. It was interesting to note last quarter how the 10-year inflation expectations by the bond market, which you can look up by looking at the 10-year break-even rate, which is synthesized from inflation-protected bonds and regular bonds. But the bond market actually has lower expectations for inflation over the next 10 years now than it did a quarter ago. I think it's in the 10 or the 2.3% range roughly. And I think the kind of the logic behind that is, the bond market is seeing all this infrastructure being constructed in the Mideast that will bypass the Strait, and they're seeing people cutting back on oil consumption. We're seeing an acceleration in the conversion of the global economy to liquefied natural gas, which is supplied largely by the U.S., Canada, Australia, and a few others. So it may be a situation that all this investment actually gives us a lower inflation rate going forward. And of course, some of it may be the impact of AI. AI technology is almost certainly going to boost productivity and GDP, but it could also have a downward push on inflation, and so the bonds largely reflect that. But we have seen some flattening of the yield curve
Jack, excuse me, we had a
recently,
client, one
oil
of our big,
prices going up.
sorry for interrupting, I'm running out of time. We had a big client here yesterday, one of our biggest clients. He was asking, do we have any long-term bonds? And I didn't really, off the tip of my tongue, have an answer for him. Um,
No, not
you,
really. I've kind of focused just on the short intermediate side of the spectrum. And the logic there is you can earn just as much yield with a fraction of the risk. We saw a situation after inflation picked up post-pandemic, where bond volatility got a lot higher. And it hasn't really gone back to normal. The bonds, the longer term bonds, are still volatile. And so by staying on the shorter end of the spectrum, you allow the bond side of the portfolio to cut the portfolio risk, but you still earn close to the same amount of yield. So yeah, I know it's kind of boring, but it is allowing the bond side to do
You
what
mean
it's
the
supposed to do.
investing that way is boring, not that we're boring, Jeff.
Well, yeah, there's just kind of we're not really getting anything from the bond side of our portfolio other than risk reduction. But at a time like this, when the stocks are booming, that's what you want the bond side to do, is give you risk reduction.
All right. Well, and hopefully renewable energy will offset some of the energy issues that the bottlenecks and so on. Jack, we are at the end of the line for this quarter. We've covered things I want to talk about: the interest rates, stocks, bonds, AI. Touched on SpaceX. I know you're near and dear to that. You've been following that from the very start. So we'll tell everybody. I know today it's 95 here in 98 here in New York.
Oh, wow.
Um, so we are using up a lot of energy right now to try and stay cool. I hope wherever you are, uh, it's comfortable.
Yes.
Jack, thank you very much. See you next time.
All righty.
All right, everybody. Thank you. Bye bye.